Yeah, it started to. So we will start the session. I think we waited for 1 full minute to all the participants to join. So, hi all, myself CA Shashikala. Welcome you all for and behalf of Team KCA to the fourth session on our income tax for the real world, a practical course for article assistant and compliance executives. Let us welcome today's session speaker CA Abhishek Murthy R, who will conduct today's session on computation of total income and taxes. To brief up on a short introduction on CA Abhishek Murthy, he is a fellow member of ICI and holds a bachelor degree in law as well as commerce, and he is also completed certificate course on TP. He has more than 9 years of experience in advising and assisting clients in various areas like personal taxation, audit, corporate taxation, international taxation, transfer pricing, and litigation. He completed his articleship from Sunderesh and Co. Chartered Accountants. Having retired as a partner at NNMS and Co. Chartered Accountants, Abhishek carries extensive experience in tax and financial services. Abhishek is also a regular faculty at various teaching institutions, inspiring next generation of chartered accountants. A warm welcome to you, sir, for on behalf of Team KSCA and all the participants. And over to you, sir. And I
Yeah,
request all the participants to post your questions in the Q&A box only, please.
okay. Thank you, ma'am. So let us begin today's session. So in the series of income tax computation, uh, I hope, means I understand that you have already completed computation of taxes under salaries and other heads of income. So the next aspect which you need to be aware are uh, provisions related to certain exemptions, certain deductions, and inter-head set off of losses, etc. And post that, we'll also try to understand the new scheme of computation of taxes, 115 BAC. And then we'll also try to understand the basics of 234A BC interest computation. So these are the things which are there for today's session. Uh, so we'll try to make it as interactive as possible. And I request you to, whatever queries you have, you're free to raise at whatever point of time we're discussing. Now, please note that this is not an in-depth or exhaustive uh, uh, coverage. This is more like we are understanding uh, the why, or because we are going or approaching our tax filing season. So we need to know certain basics, certain shortcuts, or I would say certain provisions which we come across on a very regular basis, right? That's the main objective of this session. So let's start with tax-free incomes, right? What do you mean by tax-free income? Tax-free income are incomes, okay? They are capital in nature, or they may be revenue in nature. These are capital in nature. Sometimes they are also in revenue in nature, which are originally taxable. Originally, uh, they're taxable. However, because of certain exemptions, because of certain exemptions, they are not taxed. They are not taxed, right? So now, if some income is not taxed, why is it important to understand? Point number one. Now, anyway, they are not taxed. Why is it important to reflect in the return of income? Okay, it is whether you show it or whether you don't, the tax liability doesn't get altered, right? What is the importance? Right? So the thing is, when you talk about, let's take example of agriculture income. Let's take example of agriculture income. Now, we all know agriculture income is exempt, and in order to, in,
Abhishek, sorry to interrupt, but is there a way to increase your voice? Maybe you're getting closer to your mic or something. Some of them are not able to hear.
mm, is it better?
This sounds better now.
Right. So, so we were talking about uh, what are the uh, what is the importance of understanding exempted income. So when you talk about exempted income, it is important to understand that incomes are exempt from two perspectives. One is you have earned, and then the government mandates or the law requires that you offer it for tax and then claim exemption. That is very important because the law, the way Income Tax Act has been worded, you have to first offer it for tax and then claim the exemption. That is one reason, because the law mandates. The second reason is whenever you have exempt income, let's say you have agriculture income, and then let's say you are receiving you receive the agriculture income in cash. Now, let's assume you do not show it in the return of income. And then later on, let's say there is an assessment on you, and then they happen to find this cash in survey or search, whatever it is. And then at that point of time, the first question they're going to ask you is, now, what is this cash? How did you get it? Right? Now, if I want to disclose that yes, this is agriculture income and it is already exempt from tax, the officer will obviously ask you, now in that case, why didn't you disclose in the return of income? Because there's an option to disclose, the law mandates you to disclose, but why didn't you disclose? Right? So that is another practical aspect about exempt income. Right? So After understanding what is the importance of exempt income, let's see some of the provisions of exempt incomes, right? First one is 10 subsection 1. Is it still bad? It's still bad.
So many are just telling that for them it's not much louder actually. Can you just try increasing the volume, something like that?
Increasing the volume. Okay, I may. Okay, I'll speak louder. So just let me know what if it is better now.
Yeah, seems better.
Okay, fine. I'll speak. So, so let's take the first section. That's agriculture income. Okay, we're not going to cover all the sections. We're going to touch upon only few sections which will be come across pretty often. So that's the whole objective here. We have limited time also. So let's go into that. So first one is agriculture income. So when you talk about agriculture income, the reason why agriculture income is exempt is not because government wants you to government doesn't want you to tax it. It's more like agriculture is a state subject and the central government cannot tax it. So because of this reason, agriculture income is exempt under Income Tax Act, but agriculture income is used for the purpose of aggregation, which results in change in the rate of tax or slab of tax. That's the importance of agriculture income. Now, what all things are exempt under agriculture? One, you have rent revenue derived from the land which is situated in India and used for agriculture purpose. Next, we have any income derived from such land by agriculture operations, including processing of agriculture produce, also as to render it market fit. And then we have any other income attributable to farmhouse, subject to satisfaction certain conditions. So we have three different types of agriculture income which are covered, and they are exempt. So the first one is rent or revenue. It's more like you lease the agriculture land for the purpose of agriculture. Someone else does agriculture on your behalf. That's point number one. Point number two is you grow the crops and then you convert, make them market fit. Okay, that is option two. Next, option three, you have farmhouse, which is adjacent to the agriculture, which is in a rural agriculture land, and then from that farmhouse, maybe you are letting it out for boron purpose or something like that. So these are three nature of income. If you receive it during the previous year, then they get covered under exempt income, and then you have to disclose in the return and then claim the exemption. Further, you have saplings and trees, seedlings grown in nursery also, which is going to come under agriculture income. So that is with respect to 10 subsection 1. Next is 10 subsection 2, 2A. So this section basically mandates that. So you have a assessee, okay, firm or HUF, and in this there are members or partners are there, and this HUF is liable for taxation. This HUF or firm is liable for taxation at applicable rates. Now, how does the tax computation works? Let's take example of firm. Let's say firm earns 100 rupees as profit. Profit. On that it pays 30 rupees, 70 rupees is left out, and this is distributed. Right? So now this 70, which is income of the firm, which is distributed to the partners, is received by the partners. Right? So once there is a transfer of income from one entity to one assessee to other assessee, it is technically income in the hands of the recipient. But the firm has already paid tax. So 100 rupees minus 30, 70. 70 is what is distributed. So this is already tax paid money. It is already tax paid Now, once the partner or the member of the HUF receives this tax paid money, the question is, do they have to pay the tax? The answer is no. Now, why is it no? It's because of section 10 to 10, where the law mandates that if the amount is received out of family income, or in case of impartable estate which is received out of income of family estate by any member of such HUF, and similarly for partner in LLP or a firm, then whatever they receive is exempt from taxes. It's exempt from taxes, right? However, please note that if you receive interest or remuneration, those interest or remuneration are not part of this sharing profit. They are not part of this sharing profit. Okay. Next. Next, there are certain interests earned by non-residents. Certain interests earned by non-residents. Now, there is a non-resident. Okay, he has some deposits with the Indian bank. He has some deposits with the Indian bank, and on these deposits, right? On these deposits, this non-resident is earning interest.
Sir, just a second. I request participants to just try once increasing volume from their end also, please, because we are actually able to hear him. So just want to try out from your end once also. And Abhishek sir, can you just check once also from your end? Because many are raising that voice is not clear. Or can you just rejoin at least once? Maybe we can try it out that one.
Okay, fine.
Yeah.
Now, is it better by any chance, because I am literally using something which is just next to me?
So maybe you can just try out. So just check your voice, this thing in your end, the volume and all, if it is very low or something like that.
Is it better now?
Participant, can you just, anybody just tell me whether it's fine now? Yes, sir. You can continue. I said it's fine.
Yeah. So yeah. So we next one is with respect to non-residents. Now, if a resident is there and he is investing, he's keeping certain deposits in the bank account and he's earning interest, right? Okay, thank you. So if a resident is there and he's earning interest from the bank deposits, now that is not exempt, right? That is taxable. But now for non-residents, government is saying that, see, we require foreign exchange. Okay, we require foreign exchange, that is US dollars or whatever, pound, GBP, whatever, we require this foreign currency. Now, to attract this foreign currency, and we have a large diaspora of Indian origin, people of Indian origin all across the world. Now, what government is saying that is, see, you come to India, you invest in the Indian banks, you keep the deposits, you remit the funds to India. On whatever deposits or whatever you keep, whatever interest you earn, I'm going to make it exempt. So you are already getting a better exchange rate. If you had kept, let's say you kept $1 in USA, $1 would earn you, let's say, 2% interest. But if you come and keep it in India, you can earn up to 7 to 8% interest easily. And this is taxable, but this is exempt in India. So that's a kind of benefit the government is trying to provide to non-residents, mainly to attract foreign currency transfers to India. So the how do you give the benefit? The benefit is given through section 10(4). It says that if you're an individual, okay, any income by way of interest on money standing with credit in NRE account, okay, NRE. You have to be careful here. There are two accounts generally a person can maintain. One is called NRO and one is called as NRE. In NRO account, you maintain INR, and in NRE account, you maintain foreign currency. That's the main difference between NRO account and NRE account. Okay, so the government is saying that any interest, it may be in the form of savings bank interest, it may be in the form of fixed deposit interest, whatever interest you earn in this account, okay, whatever is exempt in the hands of the non-resident. It's exempt in the hands of the non-resident. Okay, so that is the provision which the law provides. Now here the law also mandates that the exemption here is available if you're a person resident outside India, not as per Income Tax Act, but as per FEMA. Okay, but as per FEMA. But as per FEMA. Okay, so that is the provision under 10 subsection 4. Next, 10.6.2. So another provision we have is for diplomats and staff. Now, what do you mean by this? We have a lot of counselors or consulates in India. For example, we have recently in Bangalore, you had the Australian consulate open, a new consulate in Bangalore, and you have US consulate in Chennai, Hyderabad, and Bombay or Mumbai. So like that, so you have these consulates, and in these consulates, there are non-Indians or people who are not citizens of India. They come from abroad, from their own countries. They come to India, they stay in India, and they liaison between the Indian government and their home countries government, right? They liaison. So in case of these staff members, and diplomats, let's say they earn some income. Now, because they are resident in India, okay, in terms of income tax, not in terms of citizenship, in terms of resident income tax, and let's say they're resident in India, and they are being paid salaries. Technically, that becomes taxable because they're receiving salaries like anyone like us, right? It becomes taxable. But now government is saying that we don't want you to tax you for whatever income you have earned for providing these services, provided you also give similar benefits to us in your countries, to our citizens, right? So 10.6.2 says that in case of an individual who is not a citizen of India, remuneration received by him as an official, okay, of an embassy, high commission, etc., is exempt from tax if corresponding Indian official in that foreign country enjoys a similar exemption. Okay, more to do with the diplomatic channel, right? So that is one of the exemptions we have under Income Tax Act. Next, we have section 10.10(b), right? Another very commonly occurring exemption sections, 10.10(b). So what is 10.10(b)? What is the main principle of 10.10(b)? Now, it all depends on the concept of life insurance. It all depends on the concept of life insurance. Now, what is the main principle behind life insurance? It's basically everyone is contributing a small sum of money to insure risk, and that is also personal risk. Ensure risk which is in the nature of person, as in if what happens to the life of human beings, right? It all depends on that. Now, what happens practically is, if you're lucky, you don't die. If you're unlucky, you happen to die. In both the cases, in case of life insurance, in case you die, you get back whatever is the insured amount. In case you don't die, the amount accrues, and then on that you have bonus, etc., etc., and then surviving bonus, etc., you'll have, and you'll get back that money. So in this process, your intention was never to basically make money out of the transaction. Your intention was solely to secure your personal risk. It was only to secure your personal risk, right? Because in case something happens to you, so whoever is dependent on you is able to carry out their life in a comfortable manner, or until the stopgap measure, right? That is the whole intention. Now, government doesn't want it to tax, because what happens? Let's say you happen to die, and then you happen to get the money, and then whatever money you get, you happen to pay tax. If the government asks you to pay tax, then it will be, so already you're under some kind of distress, and then government again taxes it, also results in further distress to the family, right? So that is with that intention, government originally thought about exempting the proceeds of life insurance. Okay, that's our original intention. But later on, what happened was, people started using it as a device to save tax, using it as a device to save tax. So as a result of which, what you can see is, so the life insurance policies, which are pretty old, have a very flexible exemption. But later on, the flexibility given to the life insurance has decreased to a great extent, right? So that's the whole concept of section 1010. Someone raised your hand. Yes, sir. What do you have? Anyone in doubt? Are you all comfortable? Okay. So section 1010D basically says that any amount received under life insurance policy, including bonus, is exempt from tax. However, following points have to be noted. 1. Exemption is available only in respect of the amount received from life insurance policy. 1. Next, up to if you have a policy which was issued on or before 31st March 2003, it is unconditionally, the benefit under 1010D is unconditionally available. Okay. Then later on, from 2003, 1st April to 31st March 2012, the law is saying that in respect of policy issued on or after 1st April 2003 to 31st March 2012, exemption available only if the amount of premium. Okay, so we all know that every insurance policy we pay premium. So they're saying that the premium paid on such policy in any financial year does not exceed 20% of the actual capital sum assured. Okay, so we have a life insurance policy, let's say worth 10 lakh, and every basically it's a 10-year policy. Okay, this is the sum assured. Okay, and then every year you have to pay let's say 1 lakh. Okay, every year you have to pay 1 lakh as premium amount. So law is saying that the premium amount as compared to the sum assured should not be more than 20%. Premium amount per annum should not be more than 20% of the sum assured. If that is satisfied, then when this policy, that is when this life insurance policy matures, or you happen to die, in both the cases, whatever the proceeds are there, the proceeds can be sum assured plus bonus or whatever it may be. This will be exempt from taxation. Now, why the extent of 20% was brought in? Because they want to make sure that they wanted to make sure that they are genuine life insurance policies. Okay, because government gave this exemption, a lot of people started using life insurance policies as saving schemes, wherein there is no concept of taxation on the end result of the life insurance. Okay? They started using as a interest bearing security, right? So to avoid that, government brought in this concept of 20%. Now, post 1st April 2013, this 20% has been further reduced to 10%. Has been further reduced to 10%. And there is an exception to this 10%, wherein they say that if you are suffering from diseases specified under 1080 DDB, or in the name of the person suffering from disability specified in 80U, the limit will be 15%, because they understand that if you are having disabilities, the policy, the premium amount towards the policy is much higher as compared to any regular policy, because the premium amount is much higher. There is a so government wants to cover those exceptions also. That's why, in case you are covered under 80 DDB or 80U, then they increase the percentage from 10% to 15%, 10% to 15%. Okay. Now, value of premium agreed to be returned or any benefit by way of bonus or otherwise over and above sum actually assured shall not be taken into account while calculating the actual sum assured. So, for the purpose of percentage, the purpose of percentage of 20%, 10%, or 15%, what you have to make sure is you have to consider the sum assured, the premium paid by the sum assured is what is important, not the end result of the policy. End result of the policy may be higher than the sum assured, okay, because of surviving bonus, all those, etc., of the one. Okay. And this exemption, okay, this exemption has an exception to this. The what is the exception? In case you happen to die, okay, in case you happen to die, irrespective of the policy, irrespective of the coverage, so irrespective of the irrespective of what do you say, the percentages, the amount received will be exempt. In case what I'm trying to say is, so let's say there is Mr. A, he has taken a policy, and that policy he's paying a premium of 1 lakh. The let's say the policy is 5 lakhs, and he's paying 1 lakh, 1 lakh, 1 lakh. So over 5 years he's paying. So it is far higher than the 20%, 10%, whatever has been prescribed. But let's say in year 2, he happens to die, and he happens to get the whole 5 lakh rupees, that is the sum assured. Now this amount, even though you don't satisfy the condition of 10% or 15%, you'll still be able to enjoy the benefit of exemption, because this proceeds, whatever the proceed from the life insurance, what you receive is because of death, not because of survival. Right? That's the reason. That's one of the exceptions to the rule you need to keep in mind. Okay. Next, so further, the law also goes on to say that if you are having a if you are having key man insurance, if you are getting covered under 80DD3, or if you're having key man life insurance, these cases do not fall under this provision, mainly because in case of key man insurance, it's business which takes the insurance on behalf of the key manager person, etc. So in those cases, you don't get the benefit of 1010D. Further, in case of life insurance, and a hybrid what do you say, a product was developed by the insurance industry called ULIP, unit linked insurance policy. What is the basis of unit linked insurance policy? Wherein whatever you invest in terms of premium, the certain percentage goes on to get invested in equity market, certain percent gets invested in debt or interest bearing securities, and as a result of which you get a policy which will give you security. At the same time, there is a growth which is in line with the inflation. That's what was the promise of ULIP. That was the promise of ULIP, right? So this became a pretty big success in the insurance product segment, and a lot of people started subscribing to this ULIP. So government observed that this ULIP is not mainly meant for ensuring a person's life. So they wanted to curb the benefits of this. So they said that with effect from assessment year 21-22, any sum received from unit linked insurance plan ULIP is not entitled for exemption if such ULIP is issued on or after 1/2/2021, and the amount of premium payable for any of the previous year during the term of such policy exceed 2.5 lakhs. Further, if premium is payable by a person for more than one ULIP issued on or after 1/2/2021, the exemption under 1010D shall be available in respect of those ULIP where the aggregate amount does not exceed 2.5 lakhs in any of the previous year during the term of this policy. Right? So this is mainly to the government wanted to restrict the exemptions which was given to the life insurance policies, and the new product which is developed called ULIP. Okay. I don't know, some issue with the audio. I hope it is clear. Is it better now? Hello. Yeah, but
Sir,
Next. Yeah.
Is it better now?
yes, sir. Can you try it once? You are telling still. Participants, can you just confirm me once, please?
Hey, wait, I'm not speaking really well. I think you should be able to. What to do, Deepak? Should I do something?
No, I guess the problem is with the Zoom platform. See, a lot of them on the participant list are also saying that they're able to hear. I can hear you clearly. So my suggestion to those participants who are not able to hear is maybe log out and log in again. And what we'll also try to do is we'll try to upload this video on YouTube by tonight itself. So those who are not able to still hear you, they can have an option to see this recording online by tomorrow morning.
Okay, people are saying that remove the. Let's say.
But see, there are people who are saying not clear, but there are people also who are saying it is clear. So I think it is an issue not to do with your setup. It is an issue with the Zoom platform itself. I'll check with the technical team also. But meanwhile, I would request you to continue.
Okay, fine. Fine. So I hope everyone is able to hear. So I'll continue. So tax, next one is, so we saw exemptions. Now we understood why exemptions are important and how exemptions are important, right? So the concept of exemption is, just to recap, we have incomes which are taxable, but government doesn't want to tax, but for various reasons. And these reasons can range from government restrictions set in by the constitution. It can go to give certain benefits to certain under certain circumstances, like wanting to get foreign exchange revenue, as well as trying to cover certain exception circumstances like death, okay, death of a person, or death of a person, etc. Okay, last I'll try without my headphones. Hope it should be able to. Okay, are you able to hear me? Is it better? Okay, fine, great. So let's go and understand. Let's tax deductions, right? So when you talk about tax deductions, you have chapter 6A, which is the prominent place where you get most of the deductions. Okay, so some of the basic aspects which we need to understand is the total income from all heads. So basically you have salaries, you have house property, you have capital gains. So all these heads of income are combined together, and this combination is called as gross total income. Now we don't compute tax on the gross total income, we compute tax on the total income. So from the gross total income, you have to give deductions. You have to give deductions, right? These deductions are given in chapter 6A. After these deductions, after this deduction, you have total income. You have total income. So that is because this is total income on which you compute the tax. You need to understand what deductions are there which are provided by law, and and how to claim it and how much to claim. So you have to be aware of the deduction to arrive at the total income for the purpose of applying the tax rate, right? So in other words, we can say that total taxable income is equal to gross total income less deductions under section 80C to 80U. So following the general rules which have to be kept in mind before claiming the deductions under 80C to 80U. 1. No deduction under chapter 6A will be allowed against long-term capital gain, short-term capital gain under 111A, winnings from lotteries, etc., casual income, and incomes covered under 115A, AB, AC. Okay, all are non-resident income related sections. Now, why are deductions not given against these sort of incomes? The reason is they all have some way or other way certain tax incentive in terms of the rate or in terms of the computation, right? In terms of rate or in computation, they all have certain benefits. So government is already giving them a benefit. On top of that, if you allow people to take deduction, then it will be it won't have any means government cannot generate tax revenue efficiently, right? So that's the reason why on this deductions is not available on certain types of incomes which have certain tax incentives, which have certain reduced rate of taxes for whatever reason. Point number 1. Point number 2, when you talk about deductions, the aggregate amount of deduction cannot exceed in any way the gross total income, right? So these are two principal things which you need to keep in mind when you talk about deductions, right? Now, one of the prominent deductions we have under Income Tax Act is section 80C. It is section 80C. So under 80C, you have various types of deductions which are available to individual or HUF. These deductions range from PPF investment in NSC, repayment of principal component of housing loan, investment in post office time deposit, senior citizen savings scheme, stamp duty and registration charges, etc., etc. So there are various different reasons why you get deduction under section 80C. However, we are going to concentrate more about the insurance part of it, the insurance premium part of it in our discussion, because that's the most commonly occurring aspect in the tax computation, right? Now, who is eligible to take this deductions under 80C? He should be an individual or a Hindu undivided family. Only these two types of assessees can take benefit under section 80C. They can take under section 80C. In whose name should you take the policy? That is very important. If you take it in your employee's name and then you want to claim benefit, no, that's not possible. So you need to take it in certain, you need to take in the name of certain individuals. Okay. So if you're an individual, then the policy should be taken in the name of himself, spouse, children. Okay. Children can be dependent or independent. In case of HUF, who is going to claim the 80C benefit for insurance, then HUF has to take it in the name of the members of HUF. Members have HUF. So these are the two important aspects which you need to keep in mind. Next, deduction allowed. What is the amount toward to the extent of which you can get the deduction? So you can get the deduction up to 1.5 lakh rupees. Up to 1.5 lakh rupees is the maximum amount to which you can get deduction under section 80C. Now, are there any restrictions on how much insurance policy you pay? Is there any restriction on that deduction amount? Answer is yes. So we saw 20%, 10%, 15%, right? That is in case of 1010D. Similarly, under 80C also you have restrictions. It says that
deduction is restricted to 20% of the sum assured in respect of policy issued on or before 31/3/2012 and 10% in case of policy issued after 1/4/2012. In case of policy taken after 1/4/2030, in case of any person suffering from disability, etc., it is 15% of the capital sum assured. Right? So you have one limitation, that is 1,50,000. So other way, okay, as an alternate, you have one more limitation on the life insurance premium. That is, it is limited. Okay, deduction is restricted towards 20% or 10% or 15% of the capital sum assured. Right? So you have to keep both these things in mind before claiming deductions. Next, whenever you are claiming deduction, one more aspect you need to keep in mind is minimum holding period. Right? So what do you mean by minimum holding period? So let's say you take life insurance. Okay, let's say you take life insurance. This life insurance, you take it for the so this is year 1, year 2, year 3. So this life insurance is valid for let's say 3 years. So year 1 you pay, let's say 1 lakh rupees is the premium amount. It satisfies both the condition. You take the benefit. But in year 2, you dissolve the policy and take back the money. Let's assume you dissolve the policy and take back the money. In that case, what happens? Government says that because the policy has not been held for a minimum period of 2 years. In case of life insurance policy, minimum 2 years. What I'm going to do is, whatever the benefit I've given you in earlier year will become taxable in year 2. It will become taxable in year 2. Okay, so you have to satisfy the minimum holding period condition also. If you fail to satisfy the minimum holding period, whatever the deduction you took in the earlier years will become income in the year in which you close the policy. So if any of the aforesaid investments, subscriptions, etc., is terminated, sold before the minimum holding period specified above, then the deductions allowed in earlier years would be deemed as income of the previous year of termination, sale, etc. Okay. Further, whatever you have invested in that year will not be allowed to you as deduction. Okay. So that is something which you need to keep in mind when you talk about when you're taking benefit under section 80C, especially with respect to insurance policies. Right. Next, you have 80CCD and 80CCD1, 80CCD2. What is 80CCD? It's basically for pensions. It is mainly meant for pension schemes. Now, why government introduced pension? Because we all know that earlier what used to happen was government itself was managing the pension for its employees. But later on, what happened was this started becoming burdensome on the exchequer, that is the government. It became burdensome. So they came up with a plan wherein instead of we managing the pension, let's create a separate authority called NPS and let it invest in market, okay, and open it up for non-government also, so that the pension pool becomes wider. And because it becomes wider, the pension pool itself will be able to manage the pensions. Okay, earlier what used to happen, there was government organization, they used to manage their own pension fund. And because government is such a small organization as compared to the Indian economy, the number of people employed by government are pretty small as compared to the informal formal sector outside government. The pension amount payable to the employees or government employees was going to become burdensome. So that's why they set up a separate authority which manages pension now in India, and it opened up the pension scheme to both government employees as well as non-government employees. By doing that, what happens? By doing that, the pension scheme broadened, there is more inflow, and you can get more revenue from the pension fund. That's the whole intention. Now, government anyway brought it, but government, after bringing it, incentivized salaried staff and self-employed people so that they also contribute. Okay, they also contribute it, and because they wanted to incentivize people so that they can also contribute. And to incentivize that, they brought in section 80CCD1, 80CCD2. Okay, wherein government is giving you incentive so that you invest in at the national pension scheme. Now, there are two sections under 80CCD. One is there, 80CCD2 is there. Now, what are these two sections? So when you talk about pension, you need to understand that there are two pillars to the pension. One is the employee contribution. One is the employer contribution. So there are two parts to the pension scheme. There are two parts to the pension scheme. So 80CCD1, 80CCD2 has to be read on the same lines. So 80CCD1 allows individual to get tax deduction benefits from the amount you deposit in his NPS amount. That is employee contribution. This tax benefit is open to both employed as well as self-employed staff. This section applies to all such individuals, and it is even open to NRIs aged between 18 to 60. Total 80CCD exemption limit reduces the total tax liability to the government. However, there is a limit to how much you can claim under 80CCD1, like all other income tax reduction given by the government. Okay, so employee contribution is covered under 80CCD1, point number one. Point number two, there are both individuals, that is salaried staff, as well as self-employed, both can go for 80CCD1. However, there is a limit on how much you can claim deduction under 80CCD1. So how much can you claim? For employees, the amount should not cross, the deduction amount should not cross 10% of basic salary and DNS allowance in financial year, and this is limited up to 1.5 lakhs. Okay. For self-employed, the limit is 10% of the gross total income up to 1.5 lakhs. So the employee contribution, so salaried staff and you have self-employed. Salaried staff can contribute up to 10% of their salary plus DA, and this is maximum 1.5 lakhs, and self-employed, they can contribute up to 1.5 lakhs or 10% of their gross total income, right? So that is the limitation to employee contribution. That is, deduction under 80CCD1 is limited to this extent. It is limited to this extent. Under 80CCD2, you have employer contribution coming into picture. You have employer contribution coming into picture, wherein the law says that if you're here, there's no question of self-employed is not there. Here it is only salaried employees. 80CCD2 only is applicable. The deduction under 80CCD2 is applicable only in case of salaried staff. And the law says that if your employer contributes to your NPS account, your employer gets tax benefit under 80CCD2. This benefit is limited to 10% of the total income of the employer in the previous year. So 10% of the total income. Up to this much, your employer can contribute to the NPS fund. Can contribute up to 10% into the NPS fund, right? So that is with respect to the 80CC. There is no 1.5 lakh limit here. It is 10% of the total income of the employer in the previous year. Okay. Next, under section 80CCD, deduction can be claimed by both salaried as well as self-employed people. But on the other hand, it's obligatory for government employees to it's obligatory on the government. They have to compulsorily go for it. For others, it is voluntary. Okay, 2 lakh is a maximum deduction you can get. So 1.5 lakhs is here. Plus on top of this, you can have another 50,000 here, wherein the benefit will come from 80CCD1B. Okay, this is voluntary contribution by the employee. This is voluntary contribution by the employee. So it contains additional deduction of 50,000 that is available under 80CCB1B. Okay. So put together, totally 2 lakhs is what you can claim under 80CCD 1B as well as 2. All put together, you can claim only this much. And further to that, once the NPS fund matures, okay, once the NPS fund matures, then whatever proceeds you come from that, the taxation is going to happen in a different way, wherein every month whatever pension you receive, it will be taxed under salaries. There's a lump sum amount whatever you receive, there's an exemption for that also, which is separate. Okay, that is with respect to contribution to National Pension Scheme. Next, you have medical insurance premium 80D. It includes expenses also. So who can take this benefit under 80D? It will be individual or HUF can claim benefit under section 80D. So what all you can contribute and get benefit? So you can pay medical insurance premium. You can contribute to any scheme which the government has notified. You can go for preventive health checkup, and you can have medical expenditure, actual medical expenditure. However, there are certain restrictions to this. What is medical expenditure incurred by assessee being individual HUF on the health of a senior citizen person, provided that no amount has been paid to the effect or to keep in force an insurance on the health of such person. Okay, so that is the under clause C. If you are incurring expenditure and claim you want to claim benefit, but it has to be towards a senior citizen person. It has to be towards senior citizen person. Right now, in whose name should the policy be taken? So in case of individual, the deduction is available in respect of medical insurance policy taken in his own name, in the name of his spouse or her spouse, parents, and his or her dependent children. Okay, dependent children. In case of HUF, it has to be in case of the family members. Case of family members. And when you talk about senior citizen, please understand there is no concept of non-resident senior citizen. It is whenever you say senior citizen, they are always resident by default and who are the age of 60 or more at the time of the relevant previous year. So let's see what are the limits to extent you can claim the benefit. So the thing is, you can incur the expenditure or there's a limit, whichever is less is the deduction. Whichever less is the. So the expenditure can be towards 4 heads. One is insurance premium. Second one is specified schemes. Next one is preventive health checkup. And next one is medical expenditure for senior citizens. So expenditure is incurred towards these 4 items. Incurred by who? Incurred by individual or HUF. Incurred by any of these 2 people. And so expenditure incurred or whatever the limit, whichever is lesser is the deduction. So let's see what are the limitations. If you are an individual and you're taking for family and parents below 60. So for the self, family and children, you can take up to 25,000 benefit, and for parents 25,000, because here it is 25,000 because the parents are below 60 years. If you're an individual and family below 60 years and your parents are above 60 years, and then you're taking taking any of these benefits, then for you it is 25,000 is the limit, and for your parents 50,000 limit. The total limit under ADD is 75,000. If you yourself is a senior citizen and your parents are also senior citizen, then what happens for your family and your parents? The limit increases to 50,000 and the total deduction available goes up to 1 lakh rupees, right? So that is with respect to individual and their parents. If you're a HUF, okay, members of HUF, okay, any one of the member, okay, if all the member are below 60 years old, then the maximum limit for the HUF is 25,000. If where a member is also 60 years or more, then it is 50,000 is the limit. 50,000 is the limit. If you are a non-resident individual and you have a family where parents are below 60 years, your parents are below 60 years, then it is assuming the if the parents are below 60 years, then 25,000 and 25,000 because they are below 60 years. If you are a non-resident individual and family, but parents are residing in India above 60 years, then yours is limited to 25,000 and theirs can go up to 50,000 maximum. Okay, so that is totally 75,000 is the total benefit under section 80D. When you talk about preventive health insurance, preventive health checkup, sorry, then this amount is limited to maximum 5,000 rupees. Preventive health checkup is limited to maximum 5,000 rupees under this set of expenditure, 4 sets of expenditure. Okay. So what we have to do, basically, we have to understand, are you an individual, are you a HUF? Then understand how much expenses you have incurred. First limitation is towards the preventive health checkup, limited to 5,000. After that, calculate how much is towards your family, you, your spouse, and your family, and then how much is towards your parents. There is a limit for this, and there is a limit for this under section 80. Right? That's how basically it works. Yes. So expenditure or premium, please understand, it can fall under any of these 4 criteria. It can fall under premium. It can be contribution to notified schemes under central government. It can be towards preventive health checkup, provided maximum amount is 5,000. It can be medical expenses also, but it has to be incurred towards senior citizen. Right. So it is sum total of all these four, and then after you total this, then you have to put it under these two brackets. You have to put it under these two brackets and understand how much is the maximum amount allowable. Right? Maximum amount allowable. Right. Next, mode of payment. Can you pay by cash? The answer is no. Except preventive health checkup, everything else has to be paid other than cash. It has to be paid any other than cash. That's the requirement under 80D. Next is 80DDB. So you are having for yourself or for dependent person, for yourself or for dependent person, you have some serious illness, and towards that serious illness you have incurred certain expenses. And we all know how illnesses can be financially burdensome on families, and so government also understands it. They know the expenses of today's medical facilities, so government wants to give you a benefit, right? How are they going to give you a benefit? They're saying that a taxpayer can claim reduction in respect of expenditure incurred by him on medical treatment of specified diseases. Okay, it has to be medical treatment, it has to be expenditure incurred and on specified diseases. Okay, so 80DDB can be claimed by individual or HUF who's resident in India. Very important. Next, deduction is available in respect of amount of actually paid by the taxpayer on medical treatment of specified diseases ailment which is prescribed by the government. In respect of an individual, the aforesaid expenditure should be incurred on medical treatment of an individual wholly or mainly dependent spouse, children, parents, brothers, sisters of the individual. So this is important. In case of HUF, it should be incurred on medical treatment of the family members whose wholly or mainly dependent on such HUF. If this condition is very important. The taxpayer has to obtain prescription from the expert, the medical expert who's related to that disease. You have to take a prescription from them. And how much you can claim deduction under this section? It is amount actually paid on the medical treatment specified above or 40,000 rupees. Okay, it's actual expenses incurred or 40,000, whichever is lower. If the expenditure is incurred on medical treatment of senior citizen, that is the resident individual above 60 years, then 40,000 will get replaced by 1 lakh. 40,000 will get replaced by 1 lakh. Okay. So how do you take the prescription? You have Form 10I issued by the neurologist, etc., who is working in a government hospital. From them, you have to take this form. You have to take this form. Okay. And one thing you need to keep in mind is whatever, if you have a policy and then you have got any reimbursement, etc., okay, then that whatever reimbursement of such thing shall be reduced from when you're calculating the limits. You have to reduce from the limits. The amount of deduction computed under if any received from any insurer or his employer by way of reimbursement of such shall be deducted. Okay, whatever deduction you're getting, you have to reduce it from the reimbursement whatever you have got. Okay. Next, section 80E, education loan tax benefits. Right. Now, we all know how higher education can be expensive, and in order to take up the higher education, a lot of people end up taking loans, right? A lot of people end up taking loans. And when they take loan, the interest payment and the principal payment they will be there every month. You have to pay interest and principal. When you talk about principal, you have section 80C, which allows for the benefit. When you talk about interest, okay, when you talk about interest, there's a deduction available for that interest payment also. That benefit is given under section 80E. That benefit is given under section 80E. Okay. So this section offers deduction that apply to interest component of these loans. Moreover, the deduction can only be claimed by individuals once repayment of said loan has started. So actual repayment has to be there, not that you have every education loan has a moratorium period. Okay, you cannot claim deductions and deduction under moratorium period. You have to have actual repayments. It is very, very important under 80E. Taxpayer can avail these loans for themselves or on behalf of their children, spouse, students, whoever who are their legal wards. Basically, they are guardians. So if I'm guardian for someone else, I'm sending someone else for education, then on that person, if I've taken a loan, then I can take the benefit under 80E. Okay, this 80E benefit is available only for individuals. It's not available for HUF or companies, etc. So only individuals who are availed of loans under their names can claim the exemptions. Best way is basically whenever you take these loans, take it in joint name so that it's easier for you to claim the benefit. These deductions can only be availed by individuals. HUF and etc. are not available to get this benefit. It is important to note that these loans have to be availed from recognized financial and charitable institution. Therefore, provisions of 80 will not be applicable for loans from friends and relatives. Okay, it has to be taken from proper recognized financial institutions and charitable institutions. Okay, deduction can be availed for a period of deduction is available only for 8 years. So from the date you start taking deduction till 8 years, you can take this deduction. You cannot take more than that. Okay, so you have to consider the moratorium, start the payment period, then you have to take 8 years from when you start taking the deduction. Okay, you get benefit only for the interest component, not for the principal component. There is no limit under this section. Under 80E, there's no limit. Whatever interest you pay, that much deduction you get. Okay, it's not like 80C wherein there's a 1.5 lakh rupees limit. No, it's not like that. It is available for you to the extent of actual payment. Next, 80G. 80G is mainly with respect to donations. So contributions to certain relief funds and charitable institutions. If you have made certain contributions, then you can claim deductions towards these things. And whenever you make contributions to this one, there's an element of certain donations are eligible for 100%, certain donations are eligible for 50%. So depending on where you fall, which entity, which exemption you fall under, you have to claim deduction in such manner. Okay, and here, unlike 80C, there is no limit as such. Whatever how much of a contribution you make, you are eligible to how much ever you are making the contribution, that much is the eligibility. This one, there's no maximum limit as such in case of 80G. So who are eligible? Individual companies, firm, etc., everyone is eligible. Okay, are under section 80G. But one thing you need to notice: not all contributions, not all donations are eligible under 80G. The person who is receiving the donation, that is, you have donor, you have donee. So the person who's receiving the this one, they have to be recognized under Income Tax Act, and the recognition will have two parts. One is 50% recognition will be there, one is 100% recognition will be there. That this you have to be very careful on how you see this thing before you allow the deduction. Okay. Now, what is the mode in which you have to make the payment to claim the deductions? So to claim the deduction towards donation, that is, you have to make it in check, demand draft, and cash if it is below 2,000. Anything any donations you have made in kind is limited to 2,000 rupees, but not more than that. How do you claim deductions under section 80G? So whenever you make the donation, whenever you pay donation, then you get a receipt. In that receipt, they will clearly mention which entity is receiving, what is their PAN number, whether they are recognized under Income Tax Act, etc., etc. They will have all that information. So that is required when you are filing the return of income. On top of that, now from previous year onwards, you are having Form 10B, which is an acknowledgement for depositing the donation. So that also they'll be giving. So it will have a unique number, and that unique number is required to be quoted in the return of. There's no threshold limit for donation. How much ever you contribute, either 50% or 100% of that will be given to you. But the basic principle of Chapter 6A will be still applicable to you, saying that the maximum amount of allowable deduction under Chapter 6A is limited to the gross total income. So that basic concept will still apply here also. Next one is 80GG. Now, 80GG is a situation wherein there are salaried staff and there are self-employed staff. Okay. In both the cases, HRA is not there for them. Anyway, for self-employed, there is no question of HRA itself. But maybe you are a salaried person, but you do not have something called as HRA. You don't have something called as house rent allowance in salary. So if you don't have house rent allowance, then what do you do? Because you might have actually paid a rent to some person, but because you do not have house rent allowance, you cannot claim any deductions from salaries. In those cases, you come to 80GG. You come to 80GG. Okay. So in case of 80GG, you get deduction towards the rent, what you have paid. There are certain conditions for you to claim the benefit under 80GG. So let's see one by one. If you are self-employed or a salaried individual or a Hindu or divided family, can claim deduction under this one. If you have business income, you cannot, however, businesses cannot claim this deduction. So it cannot be claimed against business income. It can be claimed against any other income. That is what they are trying to say. You have not received HRA from employer at any time during the year. You are claiming 80GG. Okay, you should not have received HRA from an employer at any time. Okay. Even 1 month also, if you have received HRA, then you will not be eligible. There should not be any HRA component in your salary at all. You, your spouse, minor child, or HUO of which you are a member do not own residential accommodation where you currently reside, perform office duties or employment or carry on business or profession. So you should not own any residential accommodation where you currently reside. That is very, very important for you to claim 80GG. You will be required to file Form 10BA with details of payment of rent. If your rent amount exceeds 1 lakh, you have to quote the PAN number of the property owner also in this Form 10B. You should not have claimed HRA at any point during the financial year. If you have changed, okay, as I told you, even 1 month also you should not have got the HRA. How much is the deductions you can get under 80GG? It's not a lot amount. It's very small. It's 5,000 rupees per month or 60,000 per year. 25% of the total income having these conditions. or actual rent less 10% of income. Whichever is less will be allowed as deduction under section 80GJ. Which is it's a very small amount, but still it is some kind of deduction for people who do not have the benefit of HRA. Okay. Next. Next is 80TTA and 80TTB. Okay. So 80TT, 80TTB are mainly for the purpose of interest. Okay. 80TTA, the government mainly brought this because a lot of people have interest, and sometimes it may be very difficult for them to what do you say? It may be a very small amount, and on that government doesn't want to receive, doesn't want to tax that and then burden the people. So that's the reason why they're saying that if you're having if you're meeting this kind of threshold, then we are going to give you deduction under 80TTA and 80TTB. Okay. This section of income tax allows a taxpayer to claim deductions on interest income earned from savings bank account. Okay, purely savings bank account. The maximum tax deduction amount that can be claimed under 80 is 10,000 in a financial year. Okay, and if it exceeds this, it is taxable under other income. Next, 80TDB. The amount is 50,000 rupees annually on the interest earning from bank, post office, cooperative, bank term deposits. The tax benefit extends not just saving bank but also recurring fixed deposit, etc., etc. But it can only be claimed by senior citizens who are resident Indians, opting for, and also you have to be opting for old tax regime. Shall apply to taxpayer who must be under 60 years. That is 80TTA. You have to be a taxpayer under 60 years. And then individuals in HUF can take benefit of 80TTA. NROs also can take benefit under 80TTA because it is individual and HUF. It is not like resident, unlike 80TTB. Establishment with savings account in financial institution like banks, cooperative societies, and post office are eligible under 80TTA. Similarly, 80TTB, you must be a resident citizen, senior citizen, 60 years or older. NRI are not eligible for this benefit. Non-individual taxpayer like HUF, AOP are not also not eligible. Savings bank, fixed deposit, recurring. So here it is only savings, but here it is fixed deposit. RD is also eligible. Okay, it must be held in bank or post office to be eligible. 50,000 in the annual limit is the cumulative for all the eligible accounts put together for the senior citizen. So that is given under 80, deduction given under 80TTB. Then you have 80U. So unlike the expenditure incurred, no, 80D. ATD is in case of this one expenses. In case of HUF, you can claim. You are a member of HUF or members on 25,000, 50,000. You can claim the benefit. Next, so you have section 80U. Under 80U, here the law provides that this is an ad hoc deduction. This is not deduction like 80DD, wherein you have to have spent the money. Here it is basically if you have certain disabilities, then by default you get deductions under section 80U. Right? So who can claim deduction under section 80U? A resident individual who has been certified as a person with disability by medical authority can claim tax benefit under 80U. For the purpose of this section, a person with disability is defined as a person who has at least 40% disability certified by medical authorities. For the purpose of this section, following medical disabilities are covered. This section also provides deduction towards severe disability wherein 80% or more. The deduction is 75,000 by default deduction for people with disability, and severe disability it is 1.25 lakhs. Severe disability it's 1.25 lakh. Next, you have to get yourself certified saying that you are, whether you're you have disability or whether you have severe disability, you have to get it certified. So that is in form 10IA. That is required to claim the benefit under 80U. Okay. So that is with respect to deductions, right? Next one, we will try to understand set off and carry forward. Now, what is the principle of set off and carry forward? Whenever you are having income tax is tax on income, that is income, it's revenue minus expenses. It is revenue minus expenses. HUF can ADD and then co-members of HUF can also claim in their individual returns. So it is actual payment. What is actual payment? Whatever you pay is allowed as deduction to you, right? So if you are a member of HUF and you are paid from the HUF this HUF account, and then you are offering to tax under HUF, then it will come under HUF. If you are having income which is separate from HUF and you are having your own personal this one, and the person who's the person and you are paid separately towards that person which relates to separate different income, then yes, if it is not related to, if you are not member of HUF, then I mean if you are paying for a person who is not a member of HUF, then yes, you can take benefit and in the individual capacity also in case of ATD. Next, set off and carry forward of loss under income tax. So as we are discussing, income, total income is liable for taxation. Income Tax Act, the way the taxes work is there is revenue minus expenses, that is total income, that is taxable, So when you are having this format in which the tax calculation works, there may be certain losses incurred in one head, or there may be certain losses incurred in the same head, or there may be losses which you might not be able to set off, but you might have carried forward. In all these three cases, what happens is government understands that and then says that since I tax based on income, not based on revenue, in case you have expenses which is far more than the revenue, then you can set it off against certain incomes, or if or under against certain heads, or if you can't do that also, you can carry forward to next year and then set it off. So that is what our government understands. So that's the reason why they have provisions of set off, carry forward of losses under Income Tax Act. Now, if an income is already exempt, there is no question of carry forward or set off, because if income is exempt, then automatically loss is also exempt. So that is the one thing, one principle which you need to understand. So the way the set off and carry forward work is, first, so let's say there is salary income, there is house property income, there is business income, there is other income, capital gains. So first step is intra-head set off, that is within the head. That is, for example, you are having a house property. On house property 1, you having loss. House property 2, you have income. So this loss is set off against income to arrive at the net taxable income for the head of house property. Right? This is called as intra-head adjustment or intra-head set off. After this also, let's assume this is a loss. Then it can be set off against other heads of income. This is called as inter-head set off. So first one is intra, then next one is inter. And in case you are unable to do either of these things, then you have to carry forward. Then you have to carry forward to the next year and claim it against the similar kind of income, whatever you earn in the next year. So let's understand the concept of intra-head set off, inter-head set off, and carry forward. Okay. So by default, whatever the intra-head losses are there can be set off against the intra-head gains. Okay, that's the first principle which you need to keep in mind. Against this principle, there are certain restrictions. Okay, these restrictions are there for various reasons. Some of the reasons, for example, maybe, let's take example, you have long-term capital loss and you have short-term capital gain. You have long-term capital loss and you have short-term capital gain. Both come under the same head of capital gains. There's a loss of 20 crores and there's a gain of 10 crores. Okay, can you set off long-term and long-term capital loss against short-term capital gain? By default, yes, you can set off, but the law restricts the set off. Why? Because this is taxed at maybe 10% or 20%. This is taxed at maybe 30% or 15%. Okay, so the taxation is different in case of short-term capital gain and long-term capital gain. Right? Government is already giving you a reduced rate. Now, after giving you a reduced rate, will they allow you to take that loss from the reduced rate and set off against the higher rate of income? The answer is no. They will not allow you to do it. So that is one of the reasons why majority of the set-offs are restricted. Right? So let's see one of intra-head set-offs. So loss from speculative business cannot be set off against any other income other than income from speculative business. Okay, so loss from speculative business against cannot be set any other income other than speculative only. However, non-speculative business loss can be set off against income from speculative business. Okay, that is something which you need to keep in mind. So loss cannot be set off, but other loss can be set off against speculative business. Long-term capital loss cannot be set off against any income other than income from long-term capital gain. Okay, so long-term capital loss cannot be set off against any other gains. Only long-term only you need to have. However, short-term capital loss can be set off against long-term or short-term capital gain. Right? So short-term capital loss is at a higher rate of taxation. It can be set off against long-term or short-term capital gain. Same way, no loss can be set off against income from winning from lotteries, crossword, etc. All casual income. So you cannot set off losses against casual heads of income. They basically come under other sources. Loss from business of owning and maintaining racehorse comes under business head. Similar to speculation, wherein cannot be set off against any income other than loss from business of owning, maintaining racehorses. Right? Racehorses is basically wherein you breed as well as you make them run, all those things you do. That is the racehorse business. Next, loss from specified businesses covered under section 35 AD. So there are certain specified business like setting up cold chain facility, etc., etc. So if you have loss under these heads, it cannot be set off against any other income except the specified income from specified business only. So you may be having income from loss from cold chain, and you may be having income from warehouse. Cold chain and warehouse can be set off, but loss from cold chain cannot be set off against any other thing. Next is intra-head set off, right? So once you have tried the intra-head set off, you're still left out with losses. Okay, then what do you do with those losses? Okay, by default, each head, by default, as the main principle goes, by default, every inter-head loss can be set off against other intra-head income. However, there are certain restrictions. What are these restrictions? Before making inter-head adjustment, the taxpayer has to first make intra-head adjustment. Okay, first you have to make intra-head adjustment. Then loss from speculative business cannot be set off against any other income. You need another speculative business only to set off. Loss under capital gains, it may be short-term or long-term. Okay, doesn't matter. Cannot be set off against income under cannot be set off against income under other heads of income. Any other head cannot be set off. You have loss from casual business. No loss can be set off against income from casual business. So if you have income from casual business, no loss can be set off against that casual business. Then loss from business of maintaining a racehorse cannot be set off against any other income. Loss from 35D cannot be set off against any other income. Business loss cannot be set off against salaries. House property loss shall be allowed to be set off, but only to the extent of 2 lakhs in an assessment year. Whatever is not, you'll not be able to set off, you can carry forward for future years. Unabsorbed loss shall be allowed to be carried forward for set off in subsequent years as provided in the existing provision section. So after this also, first you do intra, then you do inter. After that also you have some losses which are left out. Then those losses you carry forward. Okay, those losses you carry forward. Okay. So next, what is the next principle? Next principle is whatever you carry forward can be set off against similar nature in the next. Whatever you carry forward can be set off against a similar nature in the next year, right? So if you have loss of any business or profession other than speculative cannot be fully adjusted in a year in which it is incurred, then the unadjusted loss can be carried forward for making adjustment in the next year. Okay, and in the subsequent years, such loss can be adjusted only against income chargeable under heads of PGBP. Okay, only against PGBP you can set off. Then loss under the head of PGBP you can carry forward and set off in the future year, provided that you have to file the return of income on or before the due date. On or before the due date, very, very important. For how many years can you carry forward and set off this PGBP? This one you can carry forward for 8 years and set off in immediately succeeding 8 years. Next, whatever we discussed is not applicable for unabsorbed depreciation. Unabsorbed depreciation is whatever unabsorbed depreciation is there, that there is no it is treated on par with depreciation which which is allowable in every year. So unabsorbed the above provisions are not restricting the unabsorbed depreciation provisions. So they can be carried forward for n number of years. There's no return of income which is required, and also it can be set off against unabsorbed depreciation can be set off against other heads of income. Then loss from business specified under 35 AD cannot be set off against any other income except income from specified business. Okay, such loss can be carried forward for adjustment income from specified business for any number of years. So 35D also cannot be set off any other except the specified business only. It has to be set off. Loss from business specified under 35D can be carried forward only if the return has been furnished within the due date. Then in case of race horses, such losses can be carried forward only for a period of 4 years. It can be carried only for 4 years, and it can be set off against the same business. It has to be set off against the same business. If loss of any speculative business cannot be fully adjusted in a year in which it is incurred, then unadjusted loss can be carried forward for making adjustment in the next year. In the subsequent year, such loss can be adjusted only against income from speculative business. Speculative can be set off against only speculative income. And when you are talking about speculative, only if you are to carry forward, you need to file the return of income also within the due date which is prescribed. And maximum you can carry forward such losses for 4 succeeding years. Okay. And unabsorbed depreciation is exception to this rule. Unabsorbed depreciation can be carried forward for n number of years, can be also carried forward without filing the return of income also. Next, with respect to losses which are there under head property, income from loss under head property, how does the carry forward works? If there's loss under the loss under head income from house property, if you cannot completely utilize in a financially in an assessment year, then you can carry forward the next year. You don't have to file it's not necessary that you have to file the return within the prescribed time. You can carry forward for 8 years succeeding this one, and whatever you have carried forward has to be set off against income from house property only. Next, with respect to capital losses, same way, in case of capital losses, it can be carried forward provided you file the return of income within due date, and then you can carry forward maximum 8 years. It has to be set off against the same heads of income. It has to be set off against same heads of income. Next, whenever you talk about carry forward and set off of losses, there are certain restrictions. There are certain restrictions apart from whatever we discussed in this one. That is with respect to change in the constitution of business. Change in the constitution of business. So whenever you have change in constitution, maybe there may be a demerger, there may be an amalgamation, there may be a conversion, whatever may be there. The law understands that you need to carry forward the losses, but law also prescribes that under these circumstances, if you meet certain conditions, then only I will allow you to carry forward the losses. If you do not meet these conditions, whenever there's a change in the constitution of business, let's say amalgamation, let's say demerger, in those cases, in case you do not satisfy these conditions, then you cannot carry forward the losses. You cannot carry forward the losses whenever there is a change in constitution. Right. So what is unabsorbed depreciation? Okay, when you talk about unabsorbed depreciation, let's say you have PGBP, you have income, let's say 100. You have depreciation, which is 40. You have expenditure, which is let's say 120. And the total expenses is 160. So 100 minus 160 is loss of 60. This loss of 60 has to be bifurcated into two parts. One is depreciation 40. This is called as unabsorbed. Because you have a loss of 60, the assessee is unable to absorb this 40 because there's a loss of 60. If the loss was, let's say, 30, then unabsorbed depreciation would have been 30. Right? So whatever the loss appears, first you have to use it against the depreciation. Then whatever is left out is nothing but business. Whatever is left out is called as business loss. So whatever loss you have, to the extent of depreciation, first to the extent of depreciation will be called as unabsorbed. Okay, you are unable to absorb the depreciation. Then balance amount will be termed as business loss. So in our example, 60, 40 is the depreciation what we have claimed this year. So to the extent of 40, it's unabsorbed. Balance 20 is called as business loss. Now, the reason why unabsorbed depreciation is an exception to the main rule is because unabsorbed depreciation is treated on par with current year depreciation. Because it is treated on par with current year depreciation, what happens is there is no concept of number of years and the return of income and the set of restrictions. And the set of restrictions what you have with respect to the depreciation. So technically, unabsorbed depreciation is not a carry forward, it's a current year depreciation. It's treated on par with current year depreciation. Right? So that is the reason why you have exceptions to the concept of unabsorbed depreciation. Okay. Hope yours clear. Okay, so whenever you have carry forward of losses, whenever there's a change in constitution, you have to be careful. You have to understand that there are certain conditions which restrict you to carry forward the losses if whenever there's a change in constitution. Okay, so constitution change can be like conversion of sole proprietor into company, or conversion of LLP into company, or conversion of private limited into LLP. Okay, amalgamation, demerger. So all these are change in constitution. Okay? So like how you have GST input credit transfer from one entity to other entity, same way here also losses also can be transferred provided conditions are satisfied. Next, whenever you are taking carry forward of losses and setting off in the current year, you have to keep also one thing in mind, that there are some cases wherein there may not be change in the constitution of the entity, but there may be change in the shareholding pattern, or there may be change in the profit sharing pattern, etc., in the firm or in the company. In those cases, what happens? Okay, now government has various reasons why they want to restrict it, because they don't want people to do shopping of loss entities. They don't want people to do that. So that's the reason why they have brought these provisions. So what are these provisions? One is in case of retirement of a partner from partnership firm. Section 78 contains provisions relating to carry forward and set off of losses in case of change in constitution of partnership from partnership due to death or retirement of partner. Okay, in such a case, the share of loss attributable to the outgoing partner cannot be carried forward by the firm. Okay, it cannot be carried forward because that much of the loss pertains to that person, and he has retired or he has died, and as a result of which that loss gets extinguished. Right. That is this is mainly brought in by the government so that to avoid trading of loss entities. Otherwise, people would have traded the loss entities to get benefit. Right. Similar way, we have inbuilt provisions in companies also, wherein in case of a company in which public are not substantially interested, okay, then the losses cannot be carried forward. Losses cannot be carried forward and set off, where the share of the company carrying not less than 51% of the voting share were beneficially held with the persons who beneficially held the shares of the company carrying not less than 50% of the on the last day of the previous year or previous years in which loss was incurred. So what is the law saying? So in financial year 22-23, you have brought forward loss of 5 crores, which pertains to 3 years, year 1, year 2, year 3. And out of 5 crores, you have to set off 2 crores, which pertains to year 1. So whatever the shareholding pattern is there in year 1, okay, at least 51%, not less than 51% of the shareholding pattern in current year and in the year in which the loss has occurred has to be same. If both are same, then you can take this loss, use it in the current year. If the shareholding pattern, okay, voting power beneficially carrying not less than 51% of the voting power has to be the same. If it is not same, then you cannot set off the losses. You cannot set off the losses. Next, for certain startups, eligible startups, this 51% is further relaxed. It is further relaxed. You can, if you happen to come across, you have to refer to this provision, right? Now, these provisions with respect to companies are not applicable in certain cases. For example, shareholding change happens because of death or by way of gift, etc., etc. Or if your assessee is a subsidiary of a foreign company and the foreign company is undergoing amalgamations, okay, or because of the shareholding is changing because of IBC, or it is changing because of NCLT, or if the shareholding pattern is changing, which is in line with section 47, 7AC, 780, which is related to basically FIS, which is not related to this. So if anything is happening with respect to these things, then this principle of restricting the brought forward loss, carry forward loss doesn't apply in case of these cases, right? So this is with respect to losses. So now we have understood deductions, we have understood exemptions, we have understood carry forward loss and set off, right, which all has impact on the total income. Next, we need to understand this rebates and reliefs. Okay, now there are these two concepts are there. One is called rebate, one is called relief. Okay, so what is rebate? Unabsorbed depreciation can be set off against salary income. No, unabsorbed depreciation cannot be set off against salary income. It is part of PGBP still. Next, when you talk about rebates, you have to understand that government, in order to give certain benefits without changing the rate of tax, has provided certain benefits. Okay, these benefits are in terms of these benefits basically are in terms of giving rebate, wherein they don't want to change the tax slabs, but for certain individuals they want to give this benefit. Okay, so they're saying that from the tax payable, okay, that is before cess, surcharge, interest, from the tax payable you can deduct certain amount. That certain amount is provided under section 87A, which says that resident individual whose total income does not exceed 5 lakhs is eligible for this rebate. However, the following shall be allowed as deduction from income tax payable, that is 100% of tax payable, or 12,500, whichever is less is allowed as rebate. Allowed as rebate. Next, when you talk about relief of salary, what happens is whenever section 89, what happens is whenever you're receiving salary, as you know, salary is taxable on receipt basis or approval, whichever is earlier. Based on this principle, what happens is in a year you may receive salary in advance, or in a year you may receive salary in arrears, or you may get gratuity benefits, commuted pension. So you may have all these benefits. Now, if these benefits, if it was received in the respective years, then let's take example, I'm getting 10 lakh rupees arrears of salary. This pertains to 10 years. So 1 lakh rupees year 1 lakh, 1 lakh, 1 lakh in that. So to that year, 1 lakh plus, let's assume you have income for that year. If this is not taxable in that year 1, but in year 10, because you have received 10 lakh together, whatever you have income for that year plus 10 lakhs you did, it went beyond the taxable limit and you have to pay tax. Then it is unjust, because if the same arrears was received in any earlier time period, okay, if it was received in year 1, year 2, year 3, whatever it is, then you would not have paid tax. But because you're receiving in year 10, because it's a lump sum amount, you breach the tax bracket. Sometimes you may breach the basic exemption limit, sometimes you may breach let's say 5 lakhs to 10 lakh limit, 10 lakh and above limit, because of the lump sum amount. In those cases, government gives something called as relief. They give something called as relief. Basically, it's an arithmetical computation wherein you need to compute the tax liability in the current year with the arrears or with the advance. Then you need to compute the tax liability thinking that the income is chargeable in those years, and then after that you have to compare both the things, and then if you happen to get any benefit, then that can be reduced from the current tax payable. That is called as relief. That is called as relief of taxes, right? So that is with respect to relief of taxes. Next we have 115 BAC. Okay, this is so for the assessment year 23-24, we have section 115 BAC. This 115 BAC has been brought in to widen the tax base. It has been brought in to widen the tax base by the government. Government is of the opinion that by reducing the number of exemptions and deduction and reducing the rate of tax and increasing the slab, they will be able to garner more revenue than they would have done otherwise. Okay, now we all know how many exemptions are there, how many deductions are there, and all these deductions, exemptions are becoming complicated. Government doesn't want to deal with that. Government is saying that I will reduce the tax rate, at the same time I will not give you any deductions. So to implement that, you have 115 BSE. You have 115 BSE. Okay. As a result of this, as you can see, you have a new tax regime, that is 115 BSE. You have the rates of tax are much means they are different as compared to the old rates of tax. Surcharge education still remains the same, but the tax regime has the new tax 115 BSE has lower tax rates as compared to the old tax regime. Now, who can go for this 115 BSE? 115 BSE can be selected by HUF individual, resident, as well as non-resident. It is applicable to all these people. It is applicable to all these people, right? So if you opt for the now, until last year, until assessment year 22-23, the 115 BSE is optional. Going forward, that is assessment year 24-25, 115 BSE is default. So there is a slight change in the way 115 BSE works as compared to current assessment year and the next assessment year. But for current assessment year, 115 BSE is still optional. And when you opt for it, then you cannot claim deductions under various heads of income. And you have to keep that in mind. And then you have to compute the taxes. And opting for new regime, it depends on what type of income you have, and the selection or rejection changes based on that. For example, if you have income which is not from business or profession, then 150 BSE, that is a new scheme, is by once you select it in a year, then that will still that will remain that you can opt and you can come out every year. Year on year, you can keep changing. So year one, you could have gone for 115 BSE. Year two, you can come back from it. Year three, you can go back again if you do not have business income or professional income. Okay. Every year, you need to file the file form to select 150 BSE. So current year also, if you had salary income last year, then you should also do the same thing in current year also. But if you have business or profession, then it is a one-time selection, and you can come out only once out of the provision. So you can you can select a presumptive. So you can select 115 BSE once, and then also you come back also only once. So both have to be means if you are maintaining the 115 BSE, you don't have to file it again. So that is something which you need to keep in mind. Okay, so yeah, so we'll just finish this part and then we'll continue the next class. Okay, so application for exercise. So the individuals that you are required to, you have to file Form 10 IE, and the filing of Form 10 IE and the filing of return are also actually quite important to claim 115 BSE or not to claim 115 BSE. So that you have to be careful. If you're having business income, then Form 10 IE, that is selection or rejection, has to happen before the due date of filing of ITR. If you are having salary income, then 10 IE has to be filed before ITR, even though ITR has been filed after the due date. Okay, so that is something which you need to keep in mind. So if you do not file Form 10 IE, whatever selection you have done is selection or coming out, whatever you want to do, is not, it cannot be enabled by law. So that's how 150 BAC works. Right. So we'll stop till here and then we'll continue in the next class. Yeah. Deepak, should I do anything of?
I request participants if they have any questions to post it on Q&A. We will wait for 5 minutes.
Okay. Yes, you can set off business laws with house property.
So there is one question in the chat box. Is asking whether we can set up business laws with house property income.
Yeah, you can. In terms of virtual digital assets, you cannot have it is taxed on gross basis, so you cannot have purchase price reduced. Yeah, it's a special rate. So you cannot claim purchase. Yes.
So I think no more questions, so we can end this session. And thank you so much, sir, for the wonderful session on computation of total income and taxes. And I really thank on all the input and insights you have given to all the attendees actually. So thank you very much. And even I thank our KCA team for organizing this event. And I request all the participants to rejoin tomorrow at 4:30 for the same session. Means on the topic summary and conclusion being the 5th day of our event. Thank you, everyone.
Yeah. Thank you.